Hello and Sat Sri Akal. So today I'm covering bridging loan basics and giving you an idea of what bridging finance is and what it's used for. Well, my clients usually consider using a bridging loan when getting standard residential or buy-to-let mortgages is difficult, and this could be due to property needing full renovation, or it could be when looking to buy at auction and funds are needed within a particular time frame, or you could simply be sort of requiring temporary funds to bridge the gap whilst waiting to sell your own home. So you may be in a chain. Bridging loans have become increasingly popular, with lending in the sector up 66% since 2015. Chain breaks originally drove an increase in residential bridging, and they've continued through to 2022, with home buyers looking to overcome breaks in their chain being the predominant borrowers driving bridging loan performance. Bridge loans are also commonly used on investment purchases, with 24% of all bridging loans used for this purpose in 2022. So chain breaks as well as investment properties. What they do is they allow some breathing space when short-term cash is needed and can be a vital source in securing a property at auction. So what is a bridging loan? Well, simply put, a bridging loan or bridge loan is a form of finance that can be used to maintain momentum in a purchase or investment when personal funds are temporarily unavailable. It does this by bridging the gap between the amount of money currently available and the total amount required. So sometimes there's a short-term requirement. Most bridging loans run for 6 to 12 months, and interest is charged on a monthly basis, with rates ranging from 0.75% to 2% a month, and it can be taken on an interest only or a repayment basis. Payments can be serviced, which means you actually pay monthly, or quite popular, they can be rolled up and deducted from the loan. When they're rolled up, what this means is payment is taken out of the loan amount requested at the onset, and you have no monthly payments. Most bridging loans are closed bridging loans, which means a final repayment date is agreed in advance by both parties. With closed bridging loans, the lender will want to see evidence of how you plan to repay the amount borrowed. Usually they can be replaced with a mortgage to settle the bridging loan. You can use bridging loans for several purposes. A bridge loan can be used to finance the purchase or renovation of a residential, business, or a commercial property, and as an alternative to taking out a second mortgage or remortgaging a property. So you use it instead of doing that. As previously mentioned, a bridge loan can be ideal for auction purchases. You have a tight time frame and funds are required. You may not have the cash release from previous or other investments, and a bridging loan can help until you do so. Likewise, bridging can be used for beating the curse of a house buying chain. When you're stuck in a chain, you're going to lose a property. A bridge loan allows you to proceed with the purchase of a new property without having to wait until all parties in the chain have exchanged contracts. Also, you may be thinking of building your dream home from scratch. Well, a bridge loan can be used to purchase the land. It can also be used to pay fees and pay for building materials until such a time as your mortgage funds come through. The key question really that most people have is, what is the cost? How much do bridging loans cost? I heard they're expensive. Well, as well as the interest charged, when considering the cost of your bridge loan, remember to also take into account the related costs in the form of broker fees, valuation fee, exit fees, solicitors fees. So they can sort of mount up. You'll also likely have to pay an arrangement fee to the lender, and some lenders will charge a fee when your bridging loan repayment period comes to an end, and that's called an exit fee. This is to cover administration fees like removing their name from the house deeds once a repayment is complete. And they give you a little bit of a hit at the end sometimes. As with most forms of finance, the interest rate applicable to the loan will depend on a number of factors, but will predominantly depend on the value of the property. They tend to be 60%, 70% of the values on offer. The lender will also consider other factors, including earnings levels, levels of saving, the agreed repayment term, and the amount borrowed. All of these will impact your interest rate and the overall cost of the loan. As far as options and choosing a lender, tons of bridging loan companies out there, lots of companies offering bridging loans and large sums of money being involved in bridging loans. It's important to choose the best fitting lender for your requirements. Always ensure that any bridge financing company is a member of the Financial Conduct Authority, FCA. This will ensure that any issues or complaints are managed in line with FCA guidelines. Now you know all there is to know about bridge loans. You may be wondering how to apply. There is a lot of other information that you need to know. Just contact me. I'd be happy to advise you in more detail, and the advice is always free. Thanks for listening, and I hope you find this information useful.